Welcome to the video on how to use Heiken candlesticks in swing trading. In this Heiken trading strategy, we look into coil spring pattern in detail. This trading strategy that we'll discuss is highly effective and has good rate of success, and hence do pay attention. I will be taking up both long and short setup along with time frame selection and instrument selection. What I'm going to explain here is very simple, and this is something you can start implementing from Monday morning. So let's get started. So let me first list out the tools required for this trading strategy. In this Heiken trading strategy, you need Heiken candlesticks and standard volume indicator only. Apart from these, there is no other indicator that you require. There is also no need for any special software, as these charts can be accessed for free. To access these charts, just head over to investing.com or tradingview.com and you can then access these charts. Do check with your broker as well, as such standard charts are now available with your broker's technical analysis platform as well. If you're using softwares like NinjaTrader, Metastock and ME Broker, then getting Heiken charts is fairly easy. Most of the technical analysis softwares have this charting method by default. So let us first understand this swing trading pattern. I had first seen this pattern in one of Steve Nissen's teaching on candlestick trading. When I researched on this, I realized that it worked really well with both standard and Heiken candlesticks. The coil trading pattern is part of 3 swing moves where each swing leg exhibits loss of momentum. This is an important point to note, and let me explain this in detail. If you look at the chart in front of you, I have marked the coil trading pattern from point A to point F. Swing from A to B is greater than that from C to D, and from C to D, the swing that you see is greater than what you see from E to F. Now it is very clear from the chart that price is coiling up in a range before it snaps out of it and moves higher. Now whenever price moves above the range, it then enters what we call the spring phase. It's important to note that this trading pattern does not form that often, and hence you won't have to choose between many stocks that you trade. If you track 10 to 15 stocks, then based on this method, you would get roughly 20 to 25 trades per year. This is one of the positive points of this swing trading strategy, as it prevents you from over trading in your own account. Now in this chart, you see the coil spring trading pattern. In this region, you can first see the coil pattern where price contracts in a range. Post this, you get the spring phase where price breaks out of the range and then heads higher with momentum. In an ideal coil spring swing trading pattern, price will spend at least 1 month in the coiling phase before attempting to move higher. Ideal phase for price contracting in a range is generally between 1 to 3 months. This is the range that I found which delivers optimum risk reward ratio. While price is contracting in a range, points B, D and F should be approximately at the same level as marked in the chart. But with each swing wave that you see, it is important for momentum to fall. This specially applies to swing move E to F. Now there are some other specific rules and filters we need to apply, and we will see this in later slides. Let us now look into the role of Heiken candlesticks in this trading pattern. This swing trading strategy was originally shown with standard candlestick charts. With standard candlestick charts though, trend and counter trend candles can confuse at times, as impact of one single candle can lead one to believe trend reversal in market. With Heiken candlesticks though, it is much easier to identify trend and counter trend candles and its overall impact in price analysis. If you prefer using standard candlesticks, you can still continue using those. But simultaneously, I would recommend that you should be using Heiken candlesticks as well. Now in this Heiken strategy, we will be using Heiken to assess momentum within the trend and the directional bias. We will also be using these to determine who remains in control, that is buyers or sellers. This is something we will be learning throughout this trading strategy in form of many examples. Let us now look at a couple of variations of coil spring trading pattern. In an ideal pattern, points B, D and F are approximately at the same price level. In a variation though, it is possible for point F to be above the region of B and D. Now this is totally fine, and this variation is the one that has high odds of success. With point F not retracing as deep as point B and D, it just reflects the underlying strength within the price. If you spot this variation on the chart, do prefer it over other variations of this swing trading pattern. Now I'll just recommend one thing here, that you should always focus on analyzing how traders might think with respect to the chart in front of you. By doing this, you would have a fair idea of consensus in the market. In this chart, with B, D and F at different levels, you get a rising triangle formation as well, which in itself is a bullish trading pattern. In this pattern, sellers are unable to drive price lower on each down leg as buyers step in and then drive prices higher. So as you are analyzing charts, you need to spot various patterns within those charts to help you understand whether the overall structure is bullish or bearish. Now this is one thing that you should be practicing each and every day with whichever trading strategy you are trying to execute. Let us look at one more variation of this swing trading pattern. In this variation, points B, D and F are in the same price range, but points A, C and E are not in the same price range. Such variations, if you see, will happen quite often, and the important thing for you is to focus on the psychological makeup of the chart. This means at all times you have to determine what is the path of least resistance and in which direction price is more likely to break out. You will also see variations where point A is too high from point C and E. In those instances, you will have to use trend line between C and E to identify entry point in this pattern. Now this is something we will look into later slides. While researching on this method, if you find some other variation, then you can validate the same by asking me in the comment section below. Because whenever you will spend time researching this pattern, I can assure you that you will find at least 10 to 15 different variations playing out on a consistent basis. Let us now understand why this swing trading pattern works. If you look at the swing move from point A to B, momentum is clearly visible. Most of the Heiken Ashi candlesticks represent strong trend on the downside. At this instance, most traders would be short in this stock. From here on, the swing move from B to C happens on strong momentum as well. This comes on back of wide range Heiken Ashi candlesticks, and this is where traders would prefer going long. That is, those who were short would actually reverse their positions and go long in the market. Move from C to D again happens with fair degree of momentum, and this is where traders move out of this stock after the series of whipsaws that they face. Once traders begin to lose interest in the stock, price then moves above the ACE trend line and then heads higher with momentum. After the breakout, those who were initially long in the range again enter the stock with a fear of missing out on the current move. This eventually takes price even higher with momentum. The main driving force behind this pattern is whipsaws within the range and then the feeling of missing out on a good trading opportunity. In this trading strategy, it is important to focus on Heiken Ashi candlesticks within the swing moves between various points. Do remember that in this strategy, we are looking for momentum exhaustion with each swing leg. And hence this is something we need to measure on a consistent basis. If you look at the swing move from point A to point B, there are 8 Heiken Ashi candles that are wide in range. This represents strong downtrend in the market. From the point C to D, there are 7 wide Heiken Ashi candlesticks which again represent momentum on the downside. But when you look at move from E to F, there are only 4 wide Heiken Ashi candles. The move from E to F is also the shortest when you compare it with A to B and C to D. What this clearly signifies is that as price moved lower, momentum reduced on the downside. This represents inability on part of sellers to drive price lower. In all the charts that you analyze, irrespective of the time frame you select, this pattern of momentum exhaustion towards the end should be visible. While assessing the strength of pattern, you need to make sure that range of Heiken Ashi candlesticks reduce in E to F swing leg. This is an important rule and this should be kept in mind. Along with this, you need to see how volume shapes up in each swing leg. In this instance, in the first swing leg from A to B, there should be pickup in volume as price moves lower. This is marked on the chart in this particular region. Followed by this, volume can either fall or be flat as price moves from C to D. There should be some increase in volume as price moves from B to C and from D to E. In the last swing move from E to F, there should be notable drop in volume. This would suggest price is moving lower with less conviction, and this in turn strengthens the coil spring pattern further. As price moves above the resistance line of A, C and E, there should be notable pickup in volume as marked here on the chart. This is what represents momentum returning on back of high volume on the upside. This is a crucial rule and this should not be skipped while trading this strategy. Let us now come to time frame selection. Do remember that we are swing trading here and therefore our time frame should be selected accordingly. What I've found is that 30-minute and 60-minute time frame works really well with this trading strategy. Most of the trades that I execute are based on 60-minute time frame chart. Make sure that you experiment with time frame once you understand this concept fully. Do remember that your time frame preference can clearly differ from what I prefer. I will also recommend for you to first start on a 60-minute time frame and then move to a 30-minute time frame or any other time frame. This is an approach I would suggest in case you're a beginner. If you're someone who wants to hold a trade for just 2 to 3 days, then you can try trading this on a 15-minute time frame as well. Underlying concept of this strategy remains the same across any time frame you select. Let us now look at the long trade setup in detail. Entry in this trading strategy is taken at time of breakout above the A, C and E resistance line. Entry can either be taken straight away after the breakout or it can be taken post the wide range Heiken Ashi candles that form in this region. Now this is very similar to what we discussed in the Heiken Ashi candlestick series. In case you have missed those videos, link to those videos would come up at top right end of your screen. In this particular chart, wide range Heiken Ashi candles showed up in this particular region and this should be your entry point. Stop loss for this trade depends on risk appetite of a trader, but when it comes to me, I prefer keeping a stop at point D for any long trade that I take in this region. Now if you're a conservative trader, then you can also place a stop in this region at point F. Exit in this Heiken Ashi strategy depends on the underlying momentum in the market. To anticipate the probable exit region, take the distance between A and B and then add it to the entry level here. In this chart, breakout happened at 5550 at this region and the distance between A and B is 350 points. Therefore, the probable exit region would be 5550 plus 350 points, that is roughly about 5900. You can also keep a fixed exit at 10 to 15% in case you spot a momentum oriented market. I hope this particular aspect is clear. Let us now look at the short setup for this trading pattern. Now short setup is very similar to the long setup, with the main difference being that short setup is very rare and should only be traded in a confirmed downtrend. If you look at the short and long setup, both clearly represent distribution and accumulation in the market. Even if you don't take swing trades based on this setup, you can clearly use this to understand the overall market structure over next few sessions. Entry in this short setup can be either taken straight away or it can be taken post wide range Heiken Ashi candles after the breakdown of A, C and E support line. I usually use the wide range candles to increase my positions once I have taken the initial entry after the breakout or breakdown. Exit in this Heiken Ashi strategy also depends on the underlying momentum. Do remember that you are short selling here and hence be ready to book out if you spot excessive momentum in the short term. To anticipate the probable exit region, take the distance between A and B and add it to the entry level at this point. In this chart, breakout happened at 8300 and the distance between A and B is roughly 300 points. And therefore, if I have taken a short trade here, I would place my exit at 8000 level. During short setups, when momentum is strong, you would typically get 2 to 3 times of distance between A and B. And during long setups, when trend is strong and momentum is favorable, this can extend to 3 to 4 times of the distance between A and point B. In this swing trading strategy, you need to use 3 broad guidelines during each phase. In swing move from A to B and C to D, wide range Heiken Ashi candlesticks should be present. Volume should also expand in this region. When it comes to E to F, make sure candles are not wide in range. Volumes during this phase should be on the lower side. When price breaks out of the A, C and E resistance line, make sure volumes expand along with wide range candles. This is where Heiken Ashi candlesticks are so useful as trending structure is easily identifiable. These 3 guidelines that I've shown here should be followed at all times. One other guideline to follow is to check for sign of strength from B to C and D to E. This is optional, but if you can spot wide range candles in these 2 phases, then this would definitely be positive. In order to proceed with this trading strategy, make sure you stick to one time frame for the next 20 trades. Take notes of your trades and do not risk more than 0.5% of your account size per trade that you take. One important aspect you have to keep in mind is that this swing trading pattern fails as well. But if you follow the steps of analyzing strength of Heiken Ashi candlesticks along with volume conditions, then more often than not, you will be on the right side of the trend. When it comes to stock selection, stick with stocks that are highly liquid in the market. This is important, else volume conditions will get distorted. I would also recommend for you to track stocks in the derivative segments as these stocks are highly liquid by nature. If there is any doubt related to Heiken Ashi candlesticks or this pattern that we have discussed, then let me know in the comments section below. So kindly